Right now, in 2026, the market is sending out signals that are so contradictory, they just seem impossible to square. Today, we're going to break down an analysis that carves a clear path through all that chaos, and believe it or not, it all starts with what just happened today.
So it all comes down to today, January 30th. Three totally separate, powerful events, any one of which could define the entire year, all happened within hours of each other. If you want to understand the forecast for 2026, you have to understand what went down today.
Okay, first up, the political bombshell. President Trump has just nominated Kevin Warsh to be the next chairman of the Federal Reserve. Now, this is a big deal. It completely shatters decades of tradition of putting these academic economists in the role, and it injects a huge dose of political uncertainty into the future of our monetary policy. At the very same time, a shockwave ripped through the commodities market. Silver just flash crashed, plunging 30%. To give you some context, that is the biggest single-day drop we've seen since the whole Hunt Brothers fiasco back in the 1980s. This is a massive signal of panic selling. And yet, while all that chaos is unfolding, we get this number, an absolutely stunning Q4 GDP report out of Taiwan, posting an incredible 12.68% growth. And look, that isn't just a statistic on a page, it's hard proof that the AI hardware boom is fueling real, explosive economic growth.
So there you have it. That's the puzzle we're trying to solve. Political chaos at the very top of the Fed, a market flashing red, and an economy that's booming, all at the same time. How on earth do these pieces fit together? Let's dive into the analysis and see if we can make sense of it all.
All right, first things first, we have to tackle the elephant in the room, this AI rally. Is it a real, sustainable boom, or are we just living through another dot-com-style bubble, partying like it's 1999 all over again? The answer to that question changes everything. Well, the core argument in this report is that unlike the dot-com era, which was pretty much built on promises and dreams, the 2026 AI boom is built on cold, hard cash flow. Just look at the comparison. Back in 2000, you had companies with zero revenue. Today, NVIDIA alone has nearly $100 billion in free cash flow. Back then, there was an oversupply of fiber optic cables. Today, we have a massive shortage of GPUs and data centers. The takeaway is pretty clear. This boom has a real, tangible economic foundation.
So, what do you call this? The analysis uses a fascinating term, a rational bubble, and the idea behind it is actually pretty straightforward. Yes, prices are high, no doubt, but they're anchored to a genuine technological revolution that is actually boosting productivity across the board. It's not just hype, it's an investment in a fundamental economic shift.
So, the forecast is clear. The optimism around AI is going to continue right through 2026. But here's the real kicker, the key insight. The nature of the rally is going to change. We should expect a major rotation of capital, shifting away from some of the speculative AI software names and into the hardware producers in Taiwan and South Korea. You know, the companies actually building the picks and shovels for this digital gold rush.
Now let's zoom out and look at the whole global picture. Because this AI boom, well, it's definitely not a rising tide lifts all boats kind of situation. The forecast points to what's being called a great divergence, which is creating some very clear winners and losers all across the world.
In the US, the outlook gets complicated. It's all about something called a bear steepening. So what does that actually mean? Put simply, it means the cost of borrowing for the long term, think mortgages and corporate debt, is going up because people are worried about inflation. At the same time, the Fed is under pressure to cut short-term rates to keep the economy going. This tug of war creates a really tricky environment for investors.
If we hop across the Atlantic, Europe is really a split story. You've got Germany, which everyone was calling the sick man of Europe not long ago, now forecast to make a dramatic comeback with over 1.2% growth, all fueled by government spending. France, on the other hand, is expected to pretty much stagnate. And then the UK is on its own path, focusing on reflating its housing market as interest rates fall.
But wow, the most dramatic contrast is happening in Asia. South Korea and Taiwan are just the undisputed winners of this AI hardware supercycle. I mean, just look at this chart. Korean semiconductor exports are projected to surge by a staggering 70%. Compare that with China, which is aiming for a much more modest, kind of L-shaped stabilization that's focused on its service economy.
Okay, so the big picture for AI looks strong, right? But the report flags a huge short-term risk that's basically right on our doorstep. We need to talk about the potential for a February shock.
And that risk is all about one person,
the new Fed nominee, Kevin Warsh. You see, this guy has what you could call a major identity crisis. Historically, he's been a hawk, someone who was against easy money policies. But now he's been nominated by a president who is demanding low interest rates. This sets him up for an incredibly tense political tightrope walk during his Senate confirmation hearings next month.
So the report lays out this potential chain reaction, like dominoes falling. Here's how it could play out. It starts with Warsh trying to prove he's independent at his hearing by sounding really tough on inflation. That spooks the bond market, sending long-term yields soaring past 5%. That sudden spike in yields triggers margin calls and a liquidity crunch, forcing big funds to sell their best assets to raise cash. And what are their best assets right now? AI stocks. The result could be a sharp, painful, but ultimately short-lived correction.
And they've actually run the numbers on this. It's not just a guess. Using quantitative models, the analysis calculates a 42% probability that the market's fear gauge, the VIX index, will spike above 30 during this February period. Let me tell you, a 42% chance, that is not a small number when you're talking about market chaos.
So after all that, the big question is, what do you do with this information? How do you navigate a year that has such a bullish long-term trend, but also a potential shockwave right in front of us? Well, this final section reframes that very crisis as a strategic opportunity.
The entire strategy really boils down to this one powerful idea. Don't be swept away by the volatile waves, see the fundamental current flowing beneath. What that really means is you have to learn to separate the short-term noise and the market panic from the powerful, long-term reality of the AI boom.
And this is maybe the most important takeaway from the entire report. The potential drop in February is predicted to be a liquidity event, not a fundamental one. This isn't the AI dream dying, it's a temporary market dislocation caused by a political event. And because that underlying economic engine is still roaring, this analysis concludes that this shock would be the single greatest buying opportunity of 2026.
And that leaves us with the final provocative question. As we stand here on the edge of this potential chaos, with these powerful forces pulling the market in opposite directions, the entire year might just come down to one decision. When that moment of panic arrives, will you be the one to buy the fear